host, Brian Kohute from HJ Wealth Management. My co-host is Pat Dunn from Merrill Lynch. We have our special guest, Griffith Gryga from Dreamit Ventures, a startup company. Pat.
Welcome.
Welcome. Good to see you. So obviously this show is taped, so we caution our viewers not to time anything off anything we say, but we can firmly say the third quarter has just ended recently, so we can talk a little about the third quarter. It was an interesting one. Markets were a little bit all over the place.
It was a very interesting one. We seem to have gotten ourselves into a trading range. We seem to be bouncing between 16,800 and 17,200, back and forth, back and forth, back and forth. So if we pull back and look at this, I think we'll look at it and say it was a straight line. It was a flat market. But the numbers are actually, for the most part, positive. We have the Dow up a little bit over 4, the S&P 500 up a little bit over 5, the NASDAQ also up about 8, interestingly enough, though, the Russell 2000 was down almost 4.5.
Rough go, yes.
And gold is essentially flat. It was up 0.25. I mean, that's pretty close to zero.
Yeah, pretty much, yeah. I guess the good news is as people get their third quarter statements for their 401ks, they mostly should see positive numbers. Other than the quarter. The quarter wasn't all that great. You work with a lot of families. Are they asking what they should be doing as we kind of roll into the year end here, or?
Not really, because the people we've worked with literally for decades, so they've been through this time and time again.
So they know not to call every time the market has a bad day.
Absolutely. A few, though, have asked, could we take a few chips off of the table, but then the next day the market rallies 200 points and they say, oh, I'm sorry I did that.
Right. Yeah.
So I think it's better just to, as long as you've got a well-diversified portfolio, stay put. The waves are going to come, just ride them.
Yeah. Now the search for yield has been an interesting for a lot of clients that are relying on income, and I'm sure you see this where your clients are stretching to get yield anywhere they can. Do you see that as an issue with some people thinking, well, the bond market's so low, there's higher yield opportunities out there, and trying to go for it?
Not so much go for it, because statistics and studies show that if you pull back on the risk and accept a little bit less yield, in the long run you'll get a better rate of return. So I think at this point most people realize that bonds is not where they want to be. Right. Dividend paying stocks, master limited partnerships, this is where we're seeing the drive for yield. Less so with the utilities and the REITs, because I think the great fear is once interest rates start to rise, they'll be the first ones to be hit.
Yeah, and I've probably been saying for the last 3 years, rates are going to go up eventually, and I'll say it again.
I will say it again.
They will eventually go up, right?
Right.
Yeah, I guess that's a little bit of what's put this volatility in the market is everyone's worried about what the Fed may do, they may not do, and we've seen a little bit of a rally in the bond market here. A lot of we talked the last show about tax planning. Do you do anything around tax planning with portfolios as you kind of go into the year end?
It's very interesting because in this relatively flat yield market that we've had, there's actually been a lot of cap gains that have been taken. Right. And usually I start dealing with year-end tax issues at year-end. Right. But I was actually starting to talk to people about let's take losses where we can as early as August. Yeah. And it's been an ongoing thing. But problem is people don't have the losses to take.
Yeah, that's been a good thing, right? I mean, it's been hard to find any losses to lower taxes.
That's right.
So that's been a positive. Europe's been a mess, and I guess it still seems to be a mess. You're probably getting calls. We occasionally get a call from our clients. Hey, should we be out of international markets altogether?
No.
Obviously, no.
No.
What do you tell your clients?
I've been concentrating really in the European markets, particularly with the big names, the industrialized names, because Europe is still in a recession. Right. And not to say that we're not, but they're still in a recession. But they're back where we were in '09. So just like the Fed's eventually going to raise rates, Europe is eventually going to start to come out of their recession, and I would rather be there to catch it the beginning of the wave. Where I'm seeing a pullback, though, is really more in the Asian markets. The Asian markets are not doing very well at all. And and there's a lot of unrest there too.
Yeah.
So between China and Hong Kong and what have you. So we've been kind of backing away from those markets.
What is your outlook on emerging markets? You tend to have exposure to those in your portfolios?
We do a well-diversified portfolio. So yes, we do have emerging markets, but I'm not putting an emphasis on it at this time.
Great. So what else are you what else are you hearing from customers, clients?
Their biggest concern is they know in their gut that you can't go up forever.
Right.
And
they've been burned twice in the last 10 years.
And they've
right?
been burned twice in the last 10 years, but we've had a very good market since March of '09, with the exception of 2011, which was really a sloppy market. And they keep saying, when's the pullback coming? When's the pullback coming? And I know it's coming. Right. I just, like when interest rates are going to go up, I can't tell you when.
Right.
So I think that's really the biggest concern on people's minds. They don't want to get out because they don't want to miss the next wave.
Right.
And yet at the same time, they're realistic enough to know that stock markets don't go straight up. They have to take a breather now and again.
It's healthy for the market, right? As painful as it is, it's healthy for the market in the long run. So.
Exactly.
You know, I guess as you say, if you got the allocation right and time horizon right, it's pretty easy. If the client can sit in their seat, our job would be easy, right?
Exactly.
So, great. Do you have time for a question from a viewer?
I do.
Great. Question comes from Joe Bonaparte in Collingswood, New Jersey. If your previous employer offers you a lump sum for your pension, what are the pros and cons of taking it or leaving it with your company or declining it? And we're actually seeing a lot of this with the big companies where somebody has a vested pension, didn't think they could touch for years, and they're getting a letter in the mail, hey, you could take it as a lump sum if you want to. Sure,
Absolutely.
You're coming across this with some clients?
We've had quite a bit of it here in the Philadelphia area, and we've received a number of calls. And I have told people that this is not a gut reaction decision. This is something you really need to discuss with a professional, because as they say in the movies, you got to follow the money. Right. And this is a complicated issue. And the corporations, many of them, have underfunded pensions. So they have a great amount of pressure on the corporation to get the employee to take a lump sum distribution.
They want them off the books.
Off the books. We don't want to be responsible for you when you're 65. And the Pennsylvania Benefits Guarantee Corp, which backs up the pensions, they have a vested interest in reducing the number of people.
They're underfunded as well, right?
Exactly. So there's a lot of pressure being applied. People are being told things like, gee, if you took this check, think what you could do with it. You could pay off debt. You could pay off your mortgage. What they're not being told is that there's a tax consequence to that. Right. And if you're under 59 and a half, there's also a penalty.
Sure, yep.
So it's not peaches and cream here.
It's easy to grab the money and run until that tax bill comes and you realize it cost you 30, 35, 40%, right?
Exactly. So, yeah. It's very expensive money to take. Now, there are pros and there are cons, so the question was well phrased. If you accept the money up front, you're accepting discounted dollars. Right. So we had a case come to us where the fellow was going to be offered $80,000. That seemed like a lot of money, but when we sat down, he would have had an $800,000 benefit if he had stayed with it. Mm-hmm. All right, so do you take the $80,000 and risk outliving your retirement funds? Right. All right. But on the other hand, what if you were in very poor health? Because if you were to die before you took this payout, the pension, right, the company may or may not pay that pension to your survivors. Right. So these are questions that need to be asked. Now, on the other hand, if you've only worked for the company for 2 or 3 years and you're not even vested, leaving it there is ridiculous, right, because it's not going to grow. Right. You might as well take it and do the rollover. So it's a very delicate issue, and decisions that people make regarding their money affect not just their lives, but the lives of the next generation. And I urge people that are in this situation to reach out to a professional who respects the connection between your life and your money.
Yes.
This is not a decision that, gee, if I took that money, I could buy a motorcycle.
Right.
It's not that kind of
Not
money.
what it was ever intended for, right? So that's a great answer. So thank you. If you have a question, here's how you send your question to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Now it's time to introduce our special guest, Griffith Gryga, with Dreamit Ventures, who has a lot of experience helping startup companies. So welcome to the show, Karen.
Thank you. Thanks for having me.
Tell us a little bit about yourself and Dreamit.
Sure. Well, Dreamit operates in a separate asset class than what you two have been speaking about. We're in the alternative asset class, high risk, high return. So Dreamit Ventures is both an accelerator and a fund. An accelerator is basically an operation where we bring in early stage technology companies. We operate 3- and 4-month programs where we work hands-on with the companies to help them validate and de-risk their businesses. So the companies that we're working with are early stage technology companies. Sometimes they're a concept, sometimes they have early customers, but the idea is that it's a big vision concept that the entrepreneurs need to figure out how to get out into the market and validate their businesses. So we operate programs whereby we pour on resources to these entrepreneurs, teach them lean startup technologies, techniques to help them validate and de-risk. So it's our goal in working with these entrepreneurs, what typically takes them 12 to 24 months to achieve on their own, we help them achieve in 3 to 6 months. And how do we do that? Dreamit was founded in 2008 by 3 local serial entrepreneurs, David Bookspan, Mike Levinson, and Steve Welch, who had each founded, grown, and exited companies. The team is made up of 12 of us, all entrepreneurs. So we have the hands-on operating knowledge and experience to help these companies build.
So you made all the mistakes that you could help them not make, right?
Yeah, certainly each one of us has had our successes and our failures, and honestly, failure's part of this business because you learn a lot from it. So Dreamit has actually launched 157 companies since 2008 through the operation of these programs.
Well, Karen, our viewers, the word accelerator may be new to them, but they could be familiar with the term incubator. Can you explain the difference between the two?
Absolutely. An accelerator is a defined time period program. In our case, it's 3 months for technology companies, 4 months for healthcare IT companies. And we're looking for the companies to achieve significant market milestones during that time period. So we actually have entrepreneurs that apply to work with us from all over the country and internationally. And during that time period, we're working to help get them out in market, get customers, determine their product market fit, and so forth. An incubator tends to be much more of a real estate play. So an incubator is a real estate space that really has been developed with early stage companies in mind, with the provision of discounted rent. They often include resources in terms of access to subject matter experts or a regular speaker series or even investor hours, but it's a much longer term real estate play, access to discounted real estate. Then an accelerator is about getting these companies in, achieving market traction, and sending them out in the world to grow and thrive.
So if I think I heard you right, Dreamit does 2 things, provides funding and also management expertise. So is that part of taking an active role in any company that you're going to invest in? Yeah, so the things that we do during the program are this. We have 2 to 3 Dreamit partners that run each cycle. They're there day in, day out working with the companies.
Some of the key exercises that we do include working with the companies and saying, what are the key assumptions behind this business against which, if you're wrong, this business will fail? And that could include the definition of the product, the target customer, the price point, all kinds of different dimensionality. We assign mentors to work with the companies, and these are experienced entrepreneurs that have the domain expertise specific to that company. We also provide 15 to 40 hours of programming a week. So that's speakers, workshops, subject matter experts, advisors, and investors, basically building their network and their knowledge base to continue to go forth and grow. We do provide a stipend, which is intended to cover their living costs while they're in the program, as well as a small amount of working capital. And then we have lawyers, accountants, and other resources. So our initial investment in the companies is in the stipend format, as well as our hands-on time for this time-intensive 3 months, which is really a life-changing experience, I have to tell you. The fund, however, is there to provide the follow-on financings for the companies. So as the companies gain momentum and traction, we have the capital to do follow-on rounds in the companies. That is on a discretionary basis, so we don't necessarily do follow-on investments in every company with which we work in the accelerator.
Well, this is very complicated with a lot of moving parts.
Yes, it is.
Can you tell me how is Dreamit itself structured?
The structure is that it is complicated with a lot of moving parts, but we do have the accelerator operation, and that operates in 5 cities at this point: Philadelphia, New York City, Austin, Texas, Baltimore, and Tel Aviv, Israel. And that is the operation where the companies apply to work with us, and we selectively choose 8 to 15 companies to work with at the time. The fund is a separate entity that is closely associated with the accelerator. It almost wraps around the accelerator. So we get equity in the companies with which we work during the program. That equity goes in the fund, and then the fund does the follow-on investments.
What does the company need to do to work with Dreamit? Do they have to file a business plan, or what's the process that you have to take them through?
We have an application process. So dreamitventures.com is the best resource for information. It is an open application, so anyone can apply. However, it's like anything else in early stage technology. If you have the opportunity to be introduced to us through a trusted advisor, a law firm, or any sort of introduction that knows us, that's the best way to get introduced. So we have open office hours, we have recruiting events, and we're very active in the community. So there's lots of ways to touch with us. And I highly recommend to entrepreneurs, if they're interested, to reach out to us to get more information.
Well, can you share with us any life stories that have come out of this, or life lessons that have come out of this?
Yeah, there's a lot of life lessons that have come out from this. If I think about it from an early stage entrepreneur perspective, the life lessons are this. Whenever you're starting up a business, you need to explicitly define the assumptions behind that business, and that is not an easy exercise to do. Then you need to actually model these assumptions, meaning, what do you think it's going to cost to acquire a customer? How many do you think will convert? What do you think the price point is? And then from day one, measure to those data points, because it's all about what the market tells you, what the data tells you. It's important, obviously, as an entrepreneur to have a vision, but you have to let the market define the opportunity for you. It's important to be extremely self-aware when you're an entrepreneur, yet to be empathetic. So you need to relate to your target customer, your target market, and you need to understand what your strengths and weaknesses are and surround yourself with resources that address us. You need to be stubborn about your vision, but not too stubborn. If the market's telling you something else, you need to listen to that something else. And whereas it's important to think through what you want to do, it's not about debates. It's about getting something done. We call it your MVP, minimal viable product. Your MVP is something that you're really embarrassed about, but it's appropriate for the market, right? So it's not a polished, finished, beautiful baby. It's something early, but you get it out to the market as soon as possible in order to get that data.
The statistics for startups and any business making it, to the second generation is not very good. Are there common mistakes that you see that you could say, yeah, these are a handful of mistakes that we see time and time again that kind of kills the business in the long run?
Well, there are a number of companies that spend 2 years developing, perfecting a product, and they bring it to market, and either no one wants it or no one's willing to pay for it. Right. So that's why this concept of getting the data from the market and specifically measuring to the market is so important. And honestly, you have to break it down into those critical elements. There might be customers, but they might be too expensive to acquire relative to your model. So it's really, all about going after the data from day one.
Well, if you were to give an entrepreneur advice about raising capital, what would you say?
There's an adage in the venture industry. You go out for capital, you get advice. You go out for advice, you get capital. So for any entrepreneur that's looking to raise capital in the market, start developing relationships with capital providers early. Start it when you don't need the capital. So, kind of as step one, these entrepreneurs need to figure out how to validate their concept, leveraging what we call intellectual capital before physical capital. And there's a lot of ways in today's technology world to do that, where it actually essentially costs $0 to get the data that you need to validate. And while you're in the process of doing that, leverage your resources, be it your neighbor, your lawyer, your accountant, to get introductions to investors, and just go meet with them and seek advice on your concept, on your approach to the market, on the data that you're gathering. The thing about early stage technology is it's a passion. And people that play in this world are passionate about it, and they're passionate about helping others because they understand that starting up a business is really, really difficult. So you reach out to someone who has expertise in this area, they'll generally help you because they want to help others because it is really challenging. So start building relationships early, start getting your data early, or if you can't get the data early, at least have the framework and the game plan on how you're going to get it.
A lot of entrepreneurs, self-included probably, they value their business way up here or their idea. How do you get them back down to more realistic expectations as you're thinking of putting money into their company?
Yeah, it's more of an art than a science. And certainly there's differences in valuation on the East Coast versus the West Coast. But generally, if it's a first stage investment round and the company's early stage, the valuation is going to be in the 1 to 4 range. So, we tell entrepreneurs, you have to look at the concept, how big the opportunity is, how experienced the management team is, and what data or traction you have. And you kind of, it's what the market's willing to pay. Sure. It's actually not that different from the public markets, but it's a little bit more opaque and difficult process. But you go talk to multiple types of investors, be it individual angels, institutional angels, or venture capitalists, and they'll tell you what they're willing to pay for something like this. Right. So again, you have to listen to the market. The only time that I caveat that is sometimes when entrepreneurs are raising capital from a group of individual investors, the entrepreneur needs to set the price. And again, there's plenty of data out there. If you're talking to, there's lawyers that focus on the startup world. There's accountants that focus on the startup world, and resources like, Dreamit, Ben Franklin, the Science Center, Wharton Entrepreneurial Center, that are all, providers of data and data points.
Yeah, I mean, yeah, there's been some changes with Kickstart and crowdfunding. Mm-hmm. Do you see it changing how you guys do business, or?
Now, for us, you know, a lot of our companies actually are exploring the crowdfunding platform. So it's a very exciting world right now, crowdfunding. And what the attempt is to democratize the funding process. Now, for any entrepreneur, the holy grail of an investor is one that has capital, has startup experience, and has domain experience. And so the entrepreneurs still need to look for this, no matter where it's, you know, feet on the street fundraising or crowdfunding fundraising, you're still looking for that. But crowdfunding just opens up the doors to the types of entities that entrepreneurs can talk to. What I have been surprised about with the crowdfunding platform is how many sophisticated investors and family offices they're actually exploring these platforms and using these platforms for deal flow. So it's a very valid source. It, however, does take work. Yes. It's not, you know, it's not about putting your materials on a crowdfunding site and calling it a day. It takes work, and each platform has its own personality and dynamic that the entrepreneurs need to understand in order to have a successful raise on that platform.
So we have about a minute or two left. Anything else you want to share with our budding entrepreneurs out there as they...
Well, you know, from my perspective and Dreamit's perspective, you know, building a startup is one of the most rewarding experiences, you know, out there. You know, when you can start with the baby of a concept and you grow it and build it, it's a tremendous experience. With Dreamit, you know, it definitely is it takes a village sort of concept. So if you have entrepreneurial experience, we're always looking for people to get involved and help our little babies grow. So.
How long do you typically, if you invest, are you in it? 7, 10 years, or is it a time horizon?
Yeah, this is, you know, it's seed stage companies, so it is a long-term time horizon. So it would be, you know, 5 to 8 years. Great.
Well, thank you for that. Obviously, we could talk all day about this, but thank you for your information. Thank you for joining Money Matters. Our next guest is Joe Murrin. He's a mortgage expert, so please tune in and join us. As always, your money matters. Thank you.